Does that mean we're going to have a crash? When there's news to be reported, the world's always coming to an end. Everybody's been freaking out about the Fed rate cuts, but what actually happened? What does it mean? And what does it mean for you and I? I'm going to share all that today, answer a couple questions, and at the end actually make sure that you have a few tips to make sure you're using it to your advantage. Hi, my name is Will. I'm with SimpleSuccessFI.com. If you're new to the channel, welcome. If you're coming back from the last video, welcome back. On this channel, I'm going to be sharing my path to financial independence with all of you and getting some feedback as I go. I'll share all the hints, tips, and tricks and tactics that I learn along the way. I really look forward to sharing the journey with a lot of you, so be sure to subscribe if you want to be a part of it. While you're down there, leave me a comment and let me know kind of where you are on the path to financial independence, or if you've even started, and leave a like as well. All right, with that, let's get right into the video. Last day of July, last Wednesday, the Federal Reserve, which is the government entity that sort of acts as the monitor and caretaker for the U.S. economy, announced it was going to be lowering the base interest rate for the first time since 2008. If you've been around for any amount of time, you know why that date is really important for the economy, or was really negative for the economy. They're going to be lowering it by 25 base points. Each base point is 1/100 of a percent, which means they're lowering it by 1/4% or 0.25%. So on a simplified version, they're actually making money cheaper to borrow. Now, face value, that sounds awesome, right? Why would that ever make anybody freak out? Problem is that on a large scale, that's not always a good thing. Additionally, usually whenever the feds lower the interest rate, that's a bad sign for the economy. And I'm going to explain that in just a minute. But to be completely clear here, I do not think this is a bad move at this point in time. So how does the Federal Reserve adjust interest rates, and why are they in the business in the first place? In short, in a nutshell, they're really indirectly manipulating the supply and demand of goods, which therefore manipulates the behavior of consumers and therefore marketers and business and industry. Now, this is a lot more simple than what it sounds and not near as nefarious either, and I'm going to explain all that. First though, you really need to just understand how the basic business or economic cycle works in the first place. I don't remember where I heard this or where I got this from, but it's really helped me for a few years now understand this. Whenever I'm thinking about the economic cycle, I kind of think about an organism breathing. So as it's expanding, it's breathing in, it's going to peak at the top, and then it's got to decompress, let the breath out, and then at the bottom, it'll stabilize and then need some air again and breathe in. So I'm going to challenge myself here a minute and a half to try to explain the economic cycle in a very brief way so that everybody can understand without having to read economic textbooks. So here we go. Let's start at the very beginning. The economy is expanding, right? We're taking a breath in. Right now, the interest rates are low, jobs are booming, consumers are spending money, and unemployment is dropping. That's a good thing. It increases the demand for goods, which means marketers are marketing, businesses are operating, and they order orders from industrial manufacturers to start making goods. This in turn increases the amount of jobs that are actually available, which increases spending again. So you see it's kind of got this compound effect. The problem is there's a point where that has to peak. There's only so many people that can consume and produce goods, right? There's actually going to be a point reached where inventory is too high for the amount of people that can consume that inventory. That's whenever the businesses are going to stop ordering more production. Whenever that happens, there's downsizes and unemployment in industrial work, right? So whenever that happens, less people are spending money. Now that starts the contraction phase. The economy has to breathe out. Once that starts, as less people are spending money, they're going to get, a little bit more tightened up in the marketing business sector and their operating costs. And whenever that happens, they have to downsize, and there's going to be some layoffs as well, which furthers the cycle. It's a downward spiral from there, where there's less people employed, less people spending money. So now it's going to go all the way down. We're breathing out, the organism's breathing out, to where at some point at the bottom it'll stabilize. So whenever it stabilizes, you'll see that the government, that's whenever they kind of step in, and I'll get to that in just a minute. And that's whenever it needs oxygen again, and we're going to start the expansion. So I know that was super brief, and if you're, a master level economist, don't get yourself into a wad. I know that is incredibly simplified, but remember, I'm trying to get this to people that may not want to have to go read a college textbook, which I've done a couple times. But I want to be able to explain it in a way that everybody can. So just calm down. Okay, so that was a really simplified, brief explanation of the economic cycle in one nutshell. But there's a few key points I want to hit on. One of them is that downward spiral for you guys, a downward spiral, where Most people would have you absolutely terrified of that. But in fact, the other term for that is market correction. See, the truth is that the market can't grow forever. First of all, there's finite resources, right? And then there's finite people. In reality, if it grew forever, we would see an even worse crash. We can't allow that to happen forever, and the market just can't sustain it. And that is a completely normal projection. The problem is that at sometimes, just like an organism, there's imbalances that throw it off. That's usually whenever there's an asset bubble or some other bubble that outpaces the rest of the market. Oftentimes, it's outpacing it so quickly that the real value of it isn't actually there in the long run. So whenever that happens, that's whenever the organism gets out of balance. I promise I'll end with biology talk. And that's whenever we see a real crash, the crash like we had in 2008. That crash was caused by some really shady loaning practices in mortgages. The good news is that today we don't have a lot of those bubbles. For the most part, the market has been steadily growing over the past decade. Now, that isn't to say they don't exist, like the constant credit bubble that is always there. But I'm just saying, in my opinion, I don't think that they are near as bad as they were in 2008. So where do the feds fit into all this? Earlier I said that they're the entity that, is responsible for economic stability. Well, they are also one of the major lenders in the United States. There's a lot of institutions that borrow from them up at the higher levels. So one of the tools that they have to help stabilize everything are the interest rates that they loan money out at. Eventually, as they change the interest rates over here, it trickles down to the rest of the market. One of the other tools they have is to print money, but I'm not going to be talking about that a whole lot here because that's a whole other subject, and it actually has an effect that would take a longer video. So why do they do this? Well, at the bottom of that cycle we talked about, whenever the contraction's kind of complete, it's gone all the way down, they may want to stimulate the economy a little bit. They do that by lowering the interest rates. That is what makes money cheaper to borrow. When they make money cheaper to borrow, businesses tend to start expansion. That's whenever they're spending more money on operating costs and marketing. That's whenever they start hiring people like I talked about before. Consumer confidence goes up and people start spending money. That starts the whole expansion phase. Now, the opposite happens at the top. At some point, there will be a time whenever everything has to kind of just calm down and cool down for just a minute. And that's whenever usually the feds would raise the rate just a little bit, make us a little bit more conservative, and would cool us off so that we don't have a burst, a crash. So the Fed rate cut right now, what does it mean? Does it mean we're going to have a crash? Maybe. No one really knows. Probably not. Or not this year anyways. But, then again, if you look, I think 4 or 5 months ago, there was a big thing where 4 different economists all came on and said, oh, we're going to have a crash this year. The truth is, nobody knows. The other kind of sad truth is that part of the economic cycle is simply self-fulfilling prophecy, legitimately. Whenever economists and media start, going a little bit crazy, investors get a little bit more conservative with their spending. Like I said before, that slows everything down. So what does the Fed rate cut mean right now? We must be in a contraction, right? Actually, the numbers don't point to that. We're still at the very end of the greatest economic expansion in the history of our nation. I think this was more to head off fear. There's a lot of fear in the air right now. We still all bear the scars of 2008 and 2009, even if we weren't adults during that time. And that stays with us. That was when the asset bubble was big enough to burst and nearly brought down the world market. It was one of the most serious, economic crises in the entire history of our nation and part of the civilized world. But right now, I think that they just didn't want the fear of the media and the self-fulfilling prophecy to take hold. So, when that happens, investors stop investing and sell assets to stockpile cash. People stop spending money, and you can have an artificial slowdown just like any other time. And I think this really was just trying to head that off and really boost the consumer and investor confidence a little bit. In fact, inflation is actually really low right now. And I want to read you something that Jeremy Powell, the chairman of the Federal Reserve, had to say. So, the U.S. economy is in a very good place, and we want to use our tools to keep it there. So 2 things. Very good place, I think, is that we are expanding at a steady rate, and inflation has made steady and low. Number 2, we want to use our tools. One of those tools is that rate cut. He also said that we want to keep the expansion going as long as possible. Right there, he's saying that, yeah, we're in an expansion, but we are at the top and going to slow down. Instead of letting media-sponsored fear drag us down early, what he's saying is we want to keep just bumping it up for a little bit longer, let it level off naturally. So on the other side of the fence, there are some very based fears. They kind of believe that we're just prolonging the inevitable. Eventually the market will have to come down, and all we're doing is keeping it propped up until it's just going to crash again. It's not baseless at all. Actually, this last year, something took place that has been the most accurate predictor of recession in the U.S. economy, in the history of the U.S. economy, and that's the yield curve inversion. What this means is that U.S. Treasury bonds are actually selling for a higher yield short term than they are long term. And that shouldn't happen. If you buy if you lock up your money longer, you should get a better yield, right? Well, whenever investors kind of get a little bit itchy about it, they're like, well, we want to, we don't see a good outlook in the long term, so we're gonna bet on the short term right now because we know it's good. And so they actually pay more for short term bond yields. This inverts a curve on a graph. I'm not going to get into that right now. Basically, for the history of the U.S. economy, this has been the most accurate predictor of recession, and it's happened for an entire quarter this year. The weird thing is, though, is that quarter was the quarter, I believe, that was the historical length of U.S. economic growth as well. So there's some contradicting factors. So it's not baseless to have a little bit of fear right now, and it is still important to use best practices. The argument I would have against that, and kind of how I feel right now, is that for that to happen, we would need an asset bubble of some sort, or some sort of other bubble that is big enough to bring everything down, like there was in 2008. I personally just don't feel like there is. Not that there isn't any bubbles. We still have a credit bubble that's always been there. But right now, I just don't think that it's big enough to bring everything down. So that brings me to, what does this all mean for you and I? At our level, our everyday investing, what does this really mean for us? And how can you use all this to your advantage? Well, like I said, it's up here and it kind of has to trickle down. We may not see the effects immediately. With that being said, though, I think we kind of already were. A few institutions here recently have already lowered their interest rates. And I do think that was in anticipation of this move and kind of the slowing down of the market in general. Winners are definitely going to be people with variable rate interest. The prime rates that credit cards are based on are going to come down a little bit. Losers are going to be traditional savers, people with CDs and the high yield savings that we've all come to know and love. I'll be honest here, I'm a loser. About a month ago, I took out a short-term CD, and if I had just went a little bit longer of a term, but hindsight's 2020, and trying to time the market is pointless. Now let's get to mortgages. HELOCs, they should see a bit of a reduction. HELOC rates should come down if they're variable, and the rates that are given right now might come down a little bit. But traditional mortgages are actually not even based on the same rates as other forms of credit. They have a longer outlook. They're actually based on 10-year treasury yields, and so they won't see the impact that everything else is seeing. Auto loans are already like mortgages in that they're sort of already as low as they can go almost, but some people still might see a reduction. And I actually read an article about having the leverage now to negotiate on a car, and that's something worth looking into if you're having to make a purchase here soon. So what should we be doing about the rate cuts, though? Calm down. Really, just calm down. Everything's going to be okay. First of all, the media makes things to be worse than they really are anyways. That's how it works. Sensationalism sells just like it always has before. Second of all, if you are using best practices and you're not doing anything shady like people were back in 2008, 2009, then you're going to be okay anyways. In the long run, if you're using best practices, you'll always come out on top. So, full disclosure, I'm not a finance professional. I'm not your finance professional. This is not meant as advice. It is meant for educational purposes only. With that being said, if a family member was to come to me today and say, hey, Will, what should I be doing right now? This is what I would tell them. Savings accounts. High yield savings accounts. Yeah, the ones we've come to know and love. We knew it was coming to an end anyways, guys. There's a good chance they are going to go down. But best practices still apply. Shop around. It's free market and someone will be competing for your business. Shop around and make sure you have your money where it's doing the best for you. Second of all, make sure that you're keeping in mind what you're saving for, what's your time horizon, and what's your risk adversity. So I already have an article I wrote about some of the places I use to keep savings, and it varies from, time horizon and from the super safe to a little bit more risky, for some people too risky, of where I really keep my savings. And with these developments, I will update that and keep that updated and make a video about it eventually. So now let's talk about debt management with the rate cuts. Obviously, you're the winner here. So if you've already been thinking about refinancing a car or mortgage loan, right now might be the time. It's already been a great time, but now is definitely a time to revisit that if you didn't. If you are looking at a credit card or consolidating credit card debt, right now might be a good time too. you can negotiate and maybe get some lower rates. So regardless of what else is going on, if you have the right strategy, you're using best practices, and you have a plan, you're going to be okay. Mindset's really everything. If you're one of those people who are going to have a knee-jerk reaction and freak out every time there's an economist that comes on the news with something sensational, say, you're gonna hurt, and you're gonna have a difficult time on the path to financial independence. I understand the economy is a murky subject. It was for me for a very long time. So I'm going to share with you a few of the books that I've read that really helped me understand and get my head around it. So first is a book that is incredibly easy to read. It sort of set the foundation for my understanding, and should for you too. It's easy to read, and he really breaks it down into bite-sized pieces for you. It's The Little Book on Economics by Greg Ip. Now, Greg Ip is a economist that's fairly famous. He's comes on the news a lot. You've probably seen him before if you've ever watched any news around economy. But this book really has helped me out, and it will you too. I'll put the link down below in the description. So the next one is a book that is just a foundational book for the financial independence community. Really kind of gives you the intestinal fortitude to make it through anything, and puts everything in the right perspective on how you should be investing, and explains what it is, kind of where I'm coming from. And now looking at it, I realize I've been saying his name wrong like 3 or 4 times. Sorry, Mr. Collins. J.L. Collins, The Simple Path to Wealth. If you've not read this book, whether you are a financial independence lover, you just want to retire in general, you should read it. It really does put you in the right mindset, and I would recommend it to anybody. So the next one is Recession-Proof Real Estate Investing by Jay Scott. Yes, I know it's a real estate book, but he does a great job of really kind of explaining the expansion and contraction cycle and how to manage your money during each one. And even though he's talking about real estate, you could really take those principles and apply it to whatever you're doing. Again, it just really gives you a good education and foundation to have the right mindset and strategy. All these books have helped me immensely. So just take a deep breath. It's going to be okay. If you have a plan and you're doing the right thing, everything's going to be okay. Make sure you educate yourself. Make sure you make that plan and you know where you're going. Backwards plan. Decide where you want to be. Backwards plan from there. So, question of the day. Is the Fed rate cut going to hinder you by, hurting your savings, or is it going to help you with the interest rate cuts? I'd really like to know what you guys have to say about it. And if you have any questions about anything else, be sure to let me know. If you liked this and you want to be a part of the journey with everybody else, make sure you subscribe, hit the bell notification icon so that you know whenever I upload. And if you do that, make sure in your comment you also tell me what number of subscriber you are. The first 100 is going to be the hardest to get to, and I really want to remember who helped me get there. Thanks, and I'll talk to you guys next time. It kind of starts up here and has to trickle down. That was goofy as hell. All right. With that being said, oh my goodness. Now I'm tickled.